Hi there. Today I want to talk about the 7 most common investor mistakes that I've seen throughout what seems like a lifetime in the wealth management industry. So the first one is probably the most common one. Trying to time the market. So, I'll sell when it's at its height and I'll buy back in when it's at the trough. It can't be done consistently over a period of time. Yes, you may get lucky once or twice. Now, timing the market, in my view, is accentuated by the fund management industry, by active fund managers telling us that they know what's going to happen next. The truth is nobody knows. You'll see in January every year predictions from fund managers as to what's going to happen. Yes, sometimes they might be right, but mostly they're not. You don't hear about that. You cannot consistently time the market. So the old adage of time in the market, not timing the market, is totally true. And I would urge you to make sure that you give your investments the time in the market that they require. So you're looking at 5, 7, 10, 15, 20 years. Most of our client families actually are very long-term investors when we look at their financial plan. You can't time the market successfully. Number 2, investing in the latest fad. So in Ireland, we've seen this. We've seen geared property funds. We've seen stuff in the papers all the time about loan notes or solar investments going pear-shaped. Don't be sucked in by it. Don't be sucked in by that chat down in the pub with your mate who's investing in this latest, greatest thing. What you should do is invest in what has always worked. If you're an evidence-based investor, that will guide your investment philosophy. That will guide exactly what you're investing in. Don't get sucked in by the next best thing. Get rich quick. I think this is really important, this one, because in the era of AI, scams, frauds, all that kind of stuff, if it seems too good to be true, that's what it is. It's too good to be true. Your investments should be slow and boring, and incrementally they will increase over a long period of time. Trying to double your money in a very short space of time, well, for sure, Metis Ireland is not the home for you, because that's not what we believe in. And we've seen these particular schemes go pear-shaped, actually most of the time. Number 4, this is a big one, and I could do a very long video on this one alone. It's the illusion of productivity along with unnecessary complexity. So you'll see a lot of the time, people getting into investment portfolios that are overly complex, that there's chopping and changing all of the time. What you'll see is that's tax inefficient, actually. It's always, I was going to say almost always, but it's always more expensive to do that, and it does not serve you. And, Warren Buffett has a famous quote saying that the wealthier individuals sometimes struggle to get into very simple solutions in terms of investment or wealth products. It's absolutely okay to be invested in one fund that's a global equity portfolio that has more than 10,000 stocks, and of course you can hold a bond element to that particular fund. But actually you can do all this in one fund. You don't need lines and lines of stuff. So just remember that. Sometimes people are drawn in by complexity, because complexity can sell when it comes to the business that we operate in. So do not get sucked into that. Simple is almost always best. Chasing past performance and star fund managers, a bit of a bugbear of mine. So you may not know these names, but kind of star fund managers, Ray Dalio, Neil Woodford, Cathy Wood and Ark. Google these people. What happens is they become star names in the fund management industry. People load in, and they tend to load in after they've had a quick high. And then you'll never see that these star fund managers have durability over a long period of time. They may get lucky at the start, and people get in after the initial uplift. Star fund managers, there hasn't been one that has endured over a long period of time. So just be careful chasing past performance. The market is the market, and tracking the market is all you need to do to be a successful investor over a long period of time. Confusing volatility with risk. I'll use an example. In the COVID pandemic, when it struck first, markets dropped by 33% in a very short space of time. And some people, unfortunately, bailed out of the markets at that stage. So they lost that 33%. Now, the vast majority of people actually stayed in the market. We don't have any client families who bailed out of the market at that stage because we were talking to them. And within a couple of months, that 33% loss had been gained back. So volatility is what the stock market does. That's an extreme example, but the stock market tends to go up and down, day in, day out. It just does. But if you zone back out or zoom out, you'll see that over time, the line incrementally increases. That's what the evidence tells us. That's what history tells us. So don't confuse volatility, which are short-term temporary declines, with risk. Risk is the risk of losing all your capital. That's going back to those get-rich-quick schemes where you put your money in and it might all be gone. If you invest in the stock market over a long period of time, you're never going to lose all of your money. Ever. Full stop. The last one is I suppose, why Metis Ireland was born, why we established the business 10 years ago now. It's to, first of all, have your holistic financial plan. And that's for you and your family to map out exactly where you are and where you're going over a long period of time. Only then can you establish exactly what kind of investment products you need, whether it's savings products, investment products, cash in the bank for your short-term money, pension portfolios. You need, first of all, to do an overall holistic plan that puts all of your resources into it in order to establish, well, what's the money for? Because if you don't know what the money is for, and someone asks you how much you need, your answer is always going to be more. That, my friends, is a very bad place to be. Trust me, I've seen it. So you need your plan. That will dictate exactly what kind of investment products you need. So for me, to try and avoid these mistakes, you need a comprehensive financial plan. And then once you've done that comprehensive financial plan, your investments should be evidence-based investments. That's what we believe in here. We've believed in it from day one, and it's been very successful for our client families. So I would urge you, please, to just consider these. Don't make these mistakes. You will be a successful investor over time.